Okay, so good morning, everyone. Welcome to a new month. It is December the 1st, 2023. This is the macro snapshot. Okay, guys, so let's first of all look at sort of what happened with OPEC yesterday. We'll just deal with that first, which, of course, the oil meeting. An interesting one because in theory, now that the dust has settled, the Saudis extended their 1 million barrel unilateral cut. So that was completely expected and underwhelmed the market. But what was interesting, there's a lot of sort of leaks and discussion. But at the end of it, what came out was that in theory, we now have about 2.2 million barrels of cuts. So in theory, we added another over about 1 million barrels of cuts. So we had like Iraq and Angola, not Angola, we had Iraq and all kinds of sort of member countries, contributing 50,000 barrels here, 120,000 barrel cut there. So in totality, also the Russians, 300,000 of oil plus 200,000, I think, of distillates. So in theory, this should have been positive for the market because in theory, this was, a bunch of members getting together and actually adding cuts. But the problem is that it wasn't really released in a joint press communique, and the cuts are voluntary. The cuts are voluntary. So there seems to be sort of no legal jeopardy that the cuts will be sort of, really sort of policed or necessarily followed through in. So I think the market was quite disappointed by that. And also remember that the bigger picture is that why are they trying to cut so much? They're trying to cut so much because demand globally is lower. And so now we have a point where we have a lot of spare capacity, if indeed these member countries do sort of follow through. And so there's always the temptation to overproduce or to not report the real numbers, et cetera, et cetera. So the market was looking for something which was a clearer sign maybe from sort of the Russians and from the Saudis that they would take on more cuts, and also that they would be policed and would not be sort of voluntary, because we all know what happens when we, I voluntarily go to the gym, twice a day. Okay, so and we saw the price reaction here. I mean, it was at a particular level, but we see here on the January contract that we have a big red candle, went down about $3 or $4, stabilizing, I guess you could say, this morning a tiny bit. But the reality is this market remains weak. I think a good way of looking at that is also to look at the curve. And the curve is not particularly strong. It's not particularly going into any kind of sharp backwardation at this point. So definitely, I think one way of looking at that over the next 24, 48 hours, next 1 or 2 trading days, is to be looking at the curves. And as you guys can see here, we have a little bit of a sort of a uptrend line here. If it breaks down below that, I honestly believe that it's relatively simple for the oil market to go down and test, let's say, about the $73 level on the January contract. Okay, so I think to me this is looking weak. I don't know. I'm just going to have a quick look and see if there are any sort of EMAs or anything like that there. No, we're below all of the EMAs, so nothing particularly holding the oil market here. So at this point, it's also going to be a question of sorry, let me just clear this. It's going to be a question of global demand. And let's see what happens. So I think here, if anything, I just want to throw this onto a 4-hour chart and just see if this is going to give us a little bit of a sense of what the next hurdles are. So as you guys can see here, when we got the news that there was, going to be a bunch of sort of voluntary cuts, market came down. I mean, this to me looks, if anything, as though it's sort of bear flagging here on a 4-hour chart. And I think, to be honest, it's going to probably break down through here and test down, $3 or $4 lower. Let's keep an eye on that today. And of course, it's also going to depend on the US dollar and interest rates and things like that. Now, talking about all of that, let's just look at, I'll just throw it back onto the daily chart. I mean, basically what's been happening is that the market has been flip-flopping every day. At one point we saw on, was it Wednesday, we saw Waller from the Fed essentially saying that, with 3 or 4 months of inflation continuing to go down, there's no particular reason for the Fed to hold interest rates where they are. The implication being that, the Fed could be cutting interest rates in 3 or 4 months. So what did we see? We saw a very big dovish repricing. We saw the equities go up a little bit, but we saw the short end of the curve have a big rally. We saw some bull steepening. We saw the US dollar being slaughtered. We saw gold going up. We saw the euro going up. But then, yesterday we had we had a bit of pushback from Mary Daly from the Fed, from the San Francisco Fed, essentially saying that absolutely there was more work to do on inflation, that they might have to hike more, and even if they weren't going to be hiking more, definitely they would not be cutting interest rates anytime soon. So we're getting a little bit of a pushback. So at this point, what's happening is that the markets are flip-flopping every day. And let's just have a look at a couple of charts to illustrate that. So if I put that, let's say, on an hourly chart, let's just get a sense of that. And what I might do here, guys, I might look at, let's say, something like the 2-year, which, by the way, has moved over to a new contract here. So forget this. This is just a contract roll. And as you, just by the way, while we're talking about that, you'll notice that the price gapped up a lot going from the December to the March contract. And that's the fact that as we further go out into March and June of 2024, of course, the market is discounting in the 2-year the future implied rate cuts. So that's not like some kind of gap up there in terms of price action. But what we're seeing here is this is on the comments of Waller. You see there was a big gap up. Move up, and then of course we had daily yesterday, and we had a bit of data coming back down. So it's flip-flopping around a little bit. And another way of looking at that is, let's say we can go and look at the what's priced in. And what I'm going to do, I'm going to take let's say the March one. This is interesting because at this point here we've got for June, we've got 27 basis points, so a full cut priced in for June, and that basically jumped a lot on the Waller comments. But what's also interesting is that the market's now pricing in 12 basis points, which is essentially like a 50% chance of a cut in as soon as March. So what I want to do here is just to look at the now this number here on the right represents the number of basis points priced in this case for March. So let's put this on a, what should we do? We'll do, let's say, we'll take it back 4 days on a 5-minute chart. So that should give us a bit of context here. So I think, if I'm not mistaken here, yeah, this is Waller's comment. So if you go back all the way to Tuesday at about 10:30 a.m., you can see here only there was 4 basis points of cuts priced in for the March meeting. Then Waller came in and said, oh, maybe we'll be cutting. So the market loved all that. And since then, I have to say, it's kind of grounded down quite a lot. The prices just sort of kept on going down. Then we had sort of, a bit of data yesterday and going up and down. But the general direction of travel here seems to be lower, does definitely seem to be lower. So at this point, we have the market saying that maybe there's a coin cost up 50-50 for March, and in May fully discounted of 27 basis points. So I guess really what we're saying here is that is much more dovish repricing. And another way of looking at that, which actually might give us we can zoom out a little bit, is, let's say, for example, if you look at the Fed funds, let's just bring this up here, the Fed funds rate. I'll just put this on, give me a second here, just to see how that's changed over, like, let's say, within a context of a week. So rather than the prices, we'll put this on the implied yield. So this is the implied yield. Put that there, and I will put that on 1 week ago. So what we have now, the live one is the orange one, and from 1 week ago is the green. I'll just zoom in here to give us a bit of clarity on all of that. So what you can see here, compared to 1 week ago, you can see how everything's been priced down quite significantly, and not so much, at the very beginning of 2024, January, February, but you can see as soon as we get into the, sort of March, April, May, June, we're talking about, anything here from 10 to 20 basis points of more dovishness. And you can see here how the market's priced down that. So clearly a dovish repricing is happening. So we have to ask ourselves, what does that mean? In theory, that could be beneficial for the stocks. But on the other hand, you have to say, why is the market pricing in dovishness? Now, apart from Fed speak, it's also pricing in dovishness because the idea here is that the economy is slowing down. So something which we really is going to be complex, but we have to try and keep an eye on, is at what point does sort of negative or, sort of bad news, so to speak, or slowing the news of a slowing economy, at what point is that considered good because the Fed will be cutting it? And at what point does that start to bleed into stock earnings or company earnings as the economy slows down? And we could start getting a situation where bad news becomes bad news. So that's the first thing. The second thing as well is that, technically this could be sort of good for gold. I guess the front end of the curve, this is going to like it, although increasingly this is being priced into the front end of the curve. And you have to say that maybe asymmetrically, the risks are actually, if we start getting hawkish stuff. So what could upset this whole narrative? And it could come as soon as today. We could get some data today, and we could get a pushback from Powell. So it's going to be very interesting today. So let's just have a look now and actually just see what's going on with today. And you can see that yesterday, I just want to look at yesterday. So it's kind of curious because we did get that sort of dovish comments from Waller, but then we, as I say, daily from the Fed pushback. We got the initial jobless claims, which supported sort of the dovish narrative, saying, oh, look, the economy is slowing down. 218,000 up from 209, and then the continuing claims. but at the end of, I mean, it's a tricky one because yes, the direction of travel does seem to be for a slowly tightening, a little bit labor market. And for sure, it does look that once you are sacked, that to find a new job, the continuing claims, it's taking a little bit longer. So yes, that does seem to be indicating that the labor market is tightening, but historically, it's still a tight market. But you know, you can read it next year and read that both ways. And next week we have a lot more data. We have ADP, we have JOLTS, and of course we have non-farm payroll. So we're going to get more clarity on the labor market next year. But then you look at personal income and maybe personal spending. And although that number came in line, you have to say that compared to last month, it went from 0.7 down to 0.2 in terms of personal spending. So again, this whole narrative that, you know, the US consumer is strong, the US consumer is spending, it's still true, but it does seem to be slowing down. So again, that's one for the doves to say, hey, listen, inflation's coming down. The real economy is slowly, you know, coming down to a soft landing. Okay, great. And then we got the PCE deflator, which came in line. But again, if you look at the core number year over year, 3.7 down to 3.5, and then 0.3 down to 0.2. So it does look as though you know, the inflation is slowly drifting downwards, and it does look as though the economy is slowly sort of softening. And yet, on the other hand, yesterday we got you know, sort of a relatively sort of hawkish reaction for these numbers. Now, was that sort of some kind of positioning, end of month, profit taking? God knows, really. So you've got to be, it's interesting, you know, things are getting pretty choppy out there. So today we have, you know, ISM manufacturing. Now we all know, just keep in mind that this is not a surprise that this slows down. The general narrative is, and the market consensus is, that the manufacturing sector globally, but also in the US, is slowing a little bit. So let's just try and put this in context here. So we have, you know, the number is expected actually to tick up a little bit. So this is kind of interesting because it's expected to tick up a little bit. Prices paid expected to tick up a little bit. Employment expected to tick up a little bit. And new orders expected to tick up a little bit. Okay, so what's saying here is kind of contradicting the other data, and just to say, well, you know, is the economy actually slowing down that much? So the point is here is that if we do get a sort of upside surprise today, that could contradict the narrative, you know, that, you know, we could get a bit of a sell-off in the front end, we could get a little bit of bear flattening maybe, and we could get a bit of repricing for the sort of from the sofa in terms of the Fed, and maybe gold will have a bit of a hit. US dollar we saw overnight had a little bit of a push upwards. So the point is, guys, it's very, very it's difficult to put on long-term trades at this point. I mean, and what we're seeing is, you know, a lot of, you know, respected commentators, some people are saying, no, the Fed absolutely is not going to cut next year, or not until sort of 6 or 9 months. The pricing is too hawkish, and therefore they're leaning hawkish, shorting, you know, things like March, June and September SOFR contracts. Then you have other people pointing to the slowing data saying, no, absolutely. We had Bill Ackman the other day saying that, you know, the Fed, not only would they be cutting, but they'd be cutting sooner rather than later in first quarter. So really at this point, there are two sides to the argument, and what's happening is that we're being sort of whiplashed around every day by the data. So probably, you know, if it's possible, those of you who want to do day trades here, that's probably not a bad way to be playing things. And of course, the big one we're going to get is basically Powell speaking today. So Powell seems to be doing two appearances, and we can see that he's speaking at 11 o'clock in a fireside chat, and I think it's at a college. So the thing is there that, I mean, in a fireside chat, talking about economic advancement, is that the appropriate policy for comments on monetary policy? I'm not quite, sorry, the appropriate forum for comments on monetary policy. I'm not exactly sure, but hey, Powell speaking. And then at 2 p.m., we also have Powell, you know, participating in a roundtable. So maybe that is going to be an opportunity for him to sort of, you know, talk a little bit more about what the way he sees things. Keep in mind as well that the Fed is going to go into a blackout period from 12 p.m., from midnight tonight. So this will be the last opportunity for the Fed and Powell himself to telegraph anything. So I guess, you know, that's the point. We need to be looking out for these comments, and, you know, just see whether Powell sort of pushes back, or whether, you know, if he's relatively sanguine about things, he says, well, you know, we're going towards a soft landing. The economy is sort of slightly sort of slowing down, but he could point to the fact that the PCE core number is coming down as well, and maybe he's relatively happy with things. I mean, you have to ask yourself, why would Powell necessarily want to push back, unless he just thinks that things, you know, he might be trying to buy himself another month or two of time, and maybe he doesn't want financial conditions to loosen too much. might just want to sort of put the brakes on that at least for another 2 or 3 months, just to let the work of the high interest rates just really slow down the economy a little bit more. We shall see. So that's about it, guys. I mean, apart from that, as I say, we had the dollar having a little bit of a bounce. Equities at an interesting point. If we just have a quick look here at the equities, I'll put it back onto the daily chart. We can see that volatility is still very low in the VIX, and we see the ES not really doing much at all, finding it difficult to push higher, and on the other hand, not particularly falling. What was interesting, though, is that yesterday, and again, this might be some kind of rebalancing, we did see a bit of outperformance of the S&P compared to the Nasdaq. And what actually got my attention was that the Dow here, which is a bit more defensive, having a big up day. So I mean, does that indicating that at month end people are getting, selling some of the stocks, the tech stocks, which have made a good gains, and putting them in some of the more defensive stocks? Again, that could just be a month end rebalancing thing. Let's see if there's follow through today. But for sure, that's kind of interesting just to look at that divergence between the Dow and something like the Nasdaq, because also yesterday we did see the equal weight having a relatively good period in the last 24 hours as well. The equal weights are up. So I just wonder whether there's a little bit of rebalancing now, going out of the tech sector, giving some of the smaller caps and the defensives a little bit of love. Although normally small caps are not going to be a defensive sector, so that's a curious one as well. Okay, guys, I'm going to leave it there, and no doubt we'll be talking again next week. Plenty of action next week in terms of the data. So have a great day and a great weekend. Thank you.